Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the Russell 2000 has been on a major charge along with the base metals. He takes a look at gold and the U.S. and Canadian dollars. VRTrader.com publisher Mark Leibovit peers into 2021 and comments whether the Dow is in for a long rally and what sectors he believes will be hot in 2021. He also has a special offer for our listeners. Market historian Bob Hoye from chartsandmarkets.com gives a historical perspective on what's happening with the markets, with a record amount of loaned margin call money sloshing around, and whether the Fed really does have the back of investors. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross, and Happy New Year.
Happy New Year to you, and I think everyone will be happy to see the rolling here of the clock and into hopefully what's a better year, especially as we hit the second half of next year.
The Russell 2000 had their best quarter ever. What's this? Yes. What's the story there?
Well, with me, when I hear somebody say the word ever, I always go, oh, yeah, well, how long's your history bank that you're looking at? Well, in this case, it is the best return that it's had. We've been looking at small caps having turned a corner, especially since the election. And once you start to see the small caps outperforming in that last calendar quarter of the year, then it generally carries right through until the first part of the next year. So here we are. The Russell, just a dramatic move. Percentage-wise, you've had such a big advance that when we take a look at it, the percentage increase here, and we look at the historical, the time frame on this rally has now matched what I would look at as the minimum number of weeks from that November low to potentially put in the high. So this week, the last week of the year, created a completed sequential count for us. We've got some good overbought readings. So trend is up. What you need to watch for is a loss of momentum. And so we'll be taking a look at things such as the moving averages underneath us. We'll be looking at the MACD, which is the measurement of momentum related to moving averages. And if those start to roll, then it definitely will be time for a decent correction, probably in the size of maybe 10 or 11%. More than just a little hiccup, it could be a pretty big one, especially for some of the high flyers. And as this market's been moving up, classically, people will go out and extend the amount of money that they're borrowing. And so when we look at margin debt as a percentage of the market, it's sitting at all-time highs right now, and on the NYSE and the NASDAQ, and it's actually up 50% since March. So in this 8-month stretch, that's just a dramatic increase in terms of the leverage that has gone into the marketplace as part of this advance. And yes, we know that the Fed has been providing lots of capital out there to try and stimulate the economy, keep things going. But so much of it has gone into the equity markets that it becomes a concern here as well. And in this case, if we go back to the data that's available to us to 1960, this is the fifth time where margin debt has been up 50% or more in an 8-month stretch. And in each of those instances, the market rolled over within the next 6 months, and what we ended up seeing was a pretty sizable correction in 3 out of the 4. One of them just ended up being a flat market after that for the better part of the year. But any change in momentum here, as far as the broad markets like the S&P or the NYSE, you probably see a pullback on that margin gap as people start to reduce the positions again, because you're going from a level of euphoria right now into what could be a stretch of, get me out rather than get me in.
What's happening with precious metals?
We are into the second week now of what is historically what people look at as one of the best stretches of the year, from December the 22nd through the end of February. It's well publicized, especially because in the last 7 years, we've got 7 out of 7 years where gold and silver have moved from that time window right at Christmas through the end of February. So it's got a 100% track record if you were long during that stretch. However, if you look at a longer time frame, and we can go back to in silver we go back to 1970, and in gold we go back to 1974. Looking at those markets in that time interval, only 60% of the years was gold up and 68% of the years was silver up during that time stretch. So the seasonality is been more skewed in the last few years than it has been on average. And the longest stretch that we've ever had has been 7 years, 7 consecutive years without a losing year in that seasonal. So right now, we're looking at this as one where the market's going to have to prove itself. I think you're going to need to see gold go through 1900, and it's flirting with that right now. There's a very, very well-established trend line from the August high. If it can manage to close through that, that would be good. Then I think you definitely would want to see it break out and have a big increase in momentum. You don't want to see it pause and pull back. It needs to, at that point, really come to life. The same type of thing for silver. I think at silver, if we can push through here on the initial resistance levels at 27, then you could be looking at a target of around 30, which is what we had last summer. So that's target levels to be looking at as far as I'm concerned. Now, when historically even though the percentages are only like 60 or 68% to the upside, the win-loss ratio, when you look at dollars won versus dollars lost in those trades, the winners have made roughly 2.4 times as much as the losers have made. So clearly it's something you want to be in. You have tight stops in particular this year, because this trade's a little long in the tooth in terms of how long it's been working. So enjoy what looks to be an attempt to get going here, but don't get married to it.
What's happening with the base metals?
Well, we've ended up with just an exceptional year for anything in the sort of the material stretch, whether it be base metals such as copper, $2 to $3.60. Been pausing up here right now. We've done some work on the long-term charts, and we got a really nice breakout down around the $3.10, maybe $3.25 level. When you look at it historically, going back off the 2011 high, the breakout there. And if we can have a pullback in this next few months, and it looks as though it's just ripe for one of those. If we can get this thing to drop back from the 360 area back into maybe that 310, 320. If it can do that and hold, our next upside targets are above the all-time high, so that would be above 450. So looking at the year, maybe by this time next year we're looking at some quite different numbers. But for where we are at this point, sort of like the precious metals, don't get married to the trade. If it starts to run out of momentum, you're best off to just sit back for a while.
How's the agricultural index been doing?
Just once again, famously over there, you take a look at the DBA, which we got on board here in the summer at 13 and a quarter. It's sitting up at 16 and change. Has managed to push through some pretty good moving averages. The thing is that when we look at the index, and you can do this if you pull up the stockcharts.com. There you can look at the GYX, and you can see that in that index, which is the bulk, the basket of the commodities, that in bear markets you will typically get recovery rallies that are 15 to 20%ers, and you got a lot of those historically. In the strong markets, rallies will typically be up around 24%. We are at that point as of right now. And so look for a pause pretty soon here and a pullback as far as the ags are concerned. Wheat might be one to have people take a look at. There's both the futures contracts and an ETF, WEAT, leave out the H, that might be worth looking at on a pullback there as well.
On the currency front, how's the Canadian dollar doing and how's the U.S. buck?
U.S. dollar, we're getting capitulation signals in here. The weekly chart, you've got down now on the index to just under 90. This was up at 94.5 in October, so it's a pretty decent drop as far as the currency is concerned. And with the capitulation, wouldn't be at all surprised if you see it bounce back maybe towards the 91.5 to 92 range. And with that, then you'd be looking at the Canadian dollar maybe settling back as well. And if we get a commodity correction in the agricultural side, that would be a headwind for the Canadian dollar. The weekly chart over there on the Canada went into a sequential sell setup as of this week. So any reversal there, I think you could easily see a 2.5 cent drop in terms of the currency.
The Canadian dollar depends a lot on the price of crude. Any action there?
Well, it's the crude spent the last week just sitting here at this $48.5 to $49 range, and there's not too much to say about it right now. Looks like it's a bit of a sleeper at this point, and just when I say that, who knows? It might come to life in the next week or so, but there's nothing that's jumping out at us as of right now. So we'll just be patient for the that side of the market. The one you do want to keep an eye on as we move through the first half of this year will be over in gasoline. This is the time of year, starting in about another 2 or 3 weeks, where you want to be looking to buy the unleaded gas. So put that on the calendar.
Ross, thank you so much for being on This Week in Money, and I hope you have a great, happy, prosperous, and healthy New Year.
Well, and that goes for one and all. So thank you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at Charts by Ross. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was the #1 U.S. stock market timer in the January 2020 edition of Timer Digest. He's speaking to us from Arizona, and we're sitting here with champagne glasses in hand as we talk on New Year's Eve.
Happy New Year to you and to all the listeners.
And Happy New Year to everybody else. Mark, first of all, do you have a special offer for our listeners to kick off the new year?
Right. Well, I still have the offer from last year. We're going to have to update it because it's tied to 2020, but it's 2020 half off. 2020 half off, 2020 half off. And when you go to vrtrader.com and you pick one of our fabulous newsletters, you go to the order page for each of them, and there's a promo code SPOT where you enter 2020 half off. So you're getting 50% off for any newsletter you sign up for, whether you do it for 1 month or 1 year. So obviously it makes sense if you like me or you like to get consistent input, go for the year because that's where you're getting your biggest break. So 2020 half off at vrtrader.com.
Some people are predicting the Dow is about to top out. Some are saying it'll be 6 months from now. Others are saying it's going to be a continuing long-term bull market. What's your look ahead for the Dow?
Okay, well, I'm a little bit of a cyclical guy, and I'm sort of stubborn in the stuff I look at. Nothing is 100%, but there's what's known as a January barometer. So I'm sort of waiting for January. An old analyst friend of mine, many of you may have heard of him, Yale Hirsch, created the Stock Traders Almanac back in the 1970s, and he was sort of a mentor of mine on a certain level. He dedicated one of his books to me and some other technicians, and he was a big influence on my life. So he created the January barometer, and I would say it's as good an indicator as any if you're trying to predict, many, many months out. The indicator basically says the first 5 days of the year could be a leading indication for the entire year. And if you close January below or above where you close in December, and that matches what happened in the first 5 days, you've got double confirmation of an up or down year. So that's part of my process. I know it sounds a little silly, but if you go back and look, there are many years, I would say the majority of them, where there is some correlation for that. And, basically, that's what it said this past year, that there was going to be some volatility during the year. We would end up higher. So it depends how much you can stomach volatility along the way. So, there's also the Groundhog Day coming in early February. A couple of weeks prior or after that, if you go back and study market history, there tends to be a little market dip just before or after Groundhog Day, sometimes a bigger sell-off. Of course, we saw a bigger sell-off this past year after the February Groundhog Day, where the market started to accelerate to the downside as the COVID thing started to hit home. So there are a lot of reasons, besides that you might want to be, a little cautious in the first quarter. We did see also a big low in March this past year. There are several bear markets that have ended in March. Not to say that it can't be a high versus a low, but there tends to be, some possibility of that happening again, and we'll sort of monitor that. There's just euphoria out there. I mean, everybody wants to be in stocks, of course. Where else are you going to put your money, I suppose? Many say it's real estate, which has been moving up as people move out of the big cities. But to say, is this going to be an up or down year or just another very choppy, volatile year is to be seen. But I would suggest that, a lot of money may be going into other markets since the Dow and the S&P and NASDAQ are so high that perhaps maybe foreign markets may do a little bit better in this coming year, particularly with the U.S. dollar weak. So let's see how it all unfolds. I'm not really going to make my forecast until we get into January and see how the market starts to trade. And be well day to day, we're always looking for individual stocks, and we tend to be more of a stock picking type of service anyway. But that's sort of where I'm at, Jim.
Is the stock market signaling an economic recovery in 2021?
Well, it seems to be saying that. I mean, money is being printed left and right. We know the story out there. Government's going to give away. We know the U.S. government's going to give away $600, and they're arguing whether they should give $2,000 to everybody, and that's just individuals, not including members of the family, that could also get more. So they're priming the pump, and they're putting a lot of money out there. The question is whether people take that money and stick it in stocks, or they just buy groceries with it. So, but a lot of money printing going on out there, and momentum seems to get to exaggerated levels, both in bull and bear markets. But, you're right. It's a good question. I mean, markets tend to be a leading indicator, 6 months in advance, they say. And, we'll just have to, wait and see. I guess the trend is your friend. But, I'm a little more cautious than that because of the high valuations. I mean, we saw Tesla, for example, get up into the low 700s in trading today, Thursday, on New Year's Eve day. Of course, I've been predicting 750 in Tesla, so it didn't surprise me, but you have this euphoria about being in one stock. Of course, that had a psychological impact as well on the market, and a practical impact on the S&P 500 since it's now a component of that index. But we seem to be overdoing it, I think, and but by the same token, you don't want to fight the tape. Money is moving in, and like I say, it may go into other markets, not necessarily the U.S. market, but as far as economic recovery is concerned, that may be an irrelevant question too, Jim, because if you're a stock market trader or investor, you could maybe care less whether the economy is doing well as long as your stocks are going up. I mean, there are a lot of stocks that go up even when the companies aren't making any money, and they're hoping to make money in the future. We saw this in the pharmaceutical industry for years, biotech in particular, where there was really no earnings at all and just losses, but stocks would go up anyway. So, I guess the question is, can you make money in the stock market, and will it continue to go up, whether the economy is coming back right away or not? I guess people hope that's the case, but you have to sort of look at what your stocks are doing, and, you're not investing in the economy, you're investing in stocks. So that's really where we need to focus, how the stock's acting, the sectors that you're looking at, the individual stocks. Do they look like they're in uptrends? Do they look like they're topping out? Does it look like they've gone too far, too fast? So those are the kind of things that I look at brtrader.com and have for, God knows, over 40 years now.
Are interest rates likely to move higher?
They have been upticking here a little bit, and I've been sort of saying that. It seems like they got way overdone, and but I'm not out there, playing the interest rate market and betting that's going to happen. I mean, there's so much Fed activity out there in terms of what they plan or they don't plan to do, and rumors of negative interest rates and so forth and so on. So, Chairman Powell had made a statement not too long ago how rates are going to stay down for a long time. So, though they may be upticking here a little bit, and it looks to me like they started to, I don't know if they're going to really go anywhere. So, as long as the Fed is looking to keep rates low, unless there's some extraordinary event that changes all that, I would assume that rates are going to stay low, and maybe the little uptick I'm seeing is just a trading comment. So let's just take it a day at a time here. But that's not what's affecting the well, I guess in a way it's sort of affecting the stock market, because you don't want to put your money in and earn 0% on your money, so you're sort of forced to look for dividend stocks or the stock market. So as long as rates are down, I suppose we could look for markets to be okay, and I guess I got to give Chairman Powell the benefit of the doubt.
Does the U.S. dollar look like it's bottoming?
I thought, well, it looked a few weeks ago like it was, but it just keeps sort of drifting down there. And I guess as the more money printing that we do here, and the more checks they send out to more people, it doesn't look like it's going to end anytime soon. It could be 2,000 now, another 2,000 in 6 months. That's not good for the U.S. dollar. So I would assume it has not bottomed. Probably will continue weak, and I'm more of a technician, so it's way oversold. It's been oversold for several weeks, but yet it's not showing a clear sign of a bottom. But I'm looking at the charts. I mean, when it does turn, there's going to be one heck of a rally. because it is way deeply oversold territory. But will it come from here or substantially lower levels? So I would give the trend the benefit of the doubt, which is down, until we get a clear buy signal.
What do you see ahead for gold in early 2021?
Well, there's a seasonal tendency for some pop into the first quarter. There's Chinese New Year coming up in February, so some of the thoughts are that it might respond to that and rally into that period of time. But I have to tell you, and I mentioned this in previous broadcasts, I mean, even though we have a core position in it in our metal resource letter, we also have some other names in there that are making money, like solar stocks and lithium and that kind of stuff, to sort of balance it, oil-related plays and so forth. But the precious metal component has been, disappointing to many of the gold bulls. As you know, we had a big blow-off, in gold just in, recent months here. Was it around early August? We peaked out. Gold got way up there. It looked like it was going to go to 2100. I think it stopped around 2060, and it's been sort of in a downtrend ever since. And it did hit some support here. I was looking for about 1750 as a pullback. We got to 1762. So as long as we hold that 1760 area, which appears to be, pretty solid at the moment, we're probably okay. If we don't really rally into the first quarter, and when I say rally, I mean really start to move, then I think the gold move is sort of is called into question on a certain level, because seasonality says it should go up. In fact, it came down from early August the way it did and had a big sharp sell-off. I don't think anybody thought when gold was $20.60 an ounce in U.S. dollars it was going to drop to $17.60 at that time, or if they all thinking it was going to 2,200 or 2,500 or 3,000 or any all kinds of numbers. So it sort of got too carried away there, and so I'm a little more, and have been a little more cynical on the gold market, though we are holding some positions and we do trade it. And I have to admit we are long here, hoping for that first quarter rally. But boy, if we take out 1760, we could be 1,500, and that could really knock the socks off the gold bulls.
What do you see ahead for silver in the early part of the new year?
Same pattern as gold. I mean, if it's going to respond, they should move together, Jim. We should see some continuation of the resumption of the strength and continuation of the little rally that started here in the last couple of weeks. And if we don't get it, silver's kaput too. I mean, to start taking out $20 an ounce, it's headed all the way back down to 12, 13, 14 again. So I'm giving it the benefit of the doubt for now because of seasonality and so forth. And one of the other comments that I had made in recent weeks or months on this broadcast is there were some years, not every year, where you saw a low in gold in mid-December, and that sort of became a trading low for a nice rally afterwards. So this year it came at the very end of November. It came a little early. So that's a seasonal pattern, which is not every year, but has happened in some years, of a low in December and a subsequent rally seems to have unfolded here, or it seems to be unfolding. So both for silver and gold, I'm giving them the benefit of the doubt, but we don't want to see those August lows come out.
We'll have more with Mark Leibovit when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit. Mark, Bitcoin is in the $30,000 US range, more than 37,000 Canadian. What do you see ahead for Bitcoin?
Well, you don't want to fight the trend there, and I got to tell you, there's so many bears out there. When Bitcoin was down, under 10,000, it got down to that 2,000-3,000 range, and it looked to me at the time that it was way overdone. A lot of discussion about how it's going to disappear, and other cryptos were going to take its place. And we've been recommending or trading on and off the Bitcoin Investment Trust, ticker symbol GBTC, over the last 2-3 years. I have to admit the strength in recent weeks even surprised me, but, it's a little overdone here on the charts, but the trend is up, and I would be surprised if Bitcoin's still got a long way to go. Not all the cryptos are acting as well. There's some that have been coming down even when Bitcoin has gone up. But, I like to see a pullback here. I mean, it just gone vertical for the last, 5 or 6 weeks. But, part of me says that, surprises could be to the upside. And, even though you mentioned the low 30,000 range, how do we know Bitcoin won't be 100,000 a coin in, a year or two? So, if I had to make a prediction on it, the most unlikely prediction would be we're going to 100,000 in the coin. Something I never thought I would say, but I could see that as a possibility if it really, gets carried away here. And, I'm going to trade it or trade the GBTC along the way, and we'll stop out if certain levels are broken. But, it may be beginning a much bigger move, and there's been a big push toward digital currency. The governments are talking about it, whether they would initiate their own or not. There's a push to get away from the cashless, get us to a cashless society. I give it the benefit of the doubt. You got to trade it. I mean, unless you're just in there at $2,000 a coin, and you're just going to sit and hope it goes to 50,000 or 100,000. But I would say the trend's up until it's not. And as a trader, I would like to see a pullback here. I mean, I like to see, a 10 or 15% correction at least, or even a 20% correction just to establish new positions. But to answer your question, still appears like it wants to go overall higher in the coming year.
Crude oil, your thoughts?
We're long. In terms of the oil stocks. We've been long for a few weeks. In our metals resource letter, as I mentioned earlier, I was pleased to see the oil's moving up, along with, some other sectors that we have in there besides gold and silver and so forth. But, everybody was bearish on crude oil as well. They didn't think it was going to go anywhere. And, one of the gut feelings I had about it is when they washed it out, back in the first quarter or second quarter when crude oil went to negative, was it $15, $16 a barrel, or was it $30 a barrel? I forget the number already. That was sort of a generational climactic washout low. It was like a crash. And the way I looked at that chart at the time, I said, gee, taking it down here to minus $20, $30 a barrel, it could rally back to $100 a barrel from here because they've cleaned everybody out. So I'm a bull. I think you're going to see higher prices. Not only that, we've got political things going on. We've got U.S. warships in the Straits of Taiwan. I'm reading today. You've got Iran out there, who's not a friendly participant. We still have our news is so enraptured in the political outcome here in the U.S. Who's going to be in, whether Trump's going to ultimately succeed or Biden isn't or not. And the discussion about the COVID virus, but there are other things in this world besides those two stories, and the realization of a military action somewhere or other outlier events can't be discounted. So I'm going to stay bullish on oil.
How are the agricultural markets looking?
They look good. In fact, I'm doing some of my own hydroponic growing because I have the view there could be some food shortages, and it might be healthier growing your own stuff anyway versus the stuff you get in the stores. Even though they say it's organic, I still hear some of the stuff is sprayed, and we don't have all the nutrients in the soils that we used to have, that our grandparents benefited from, or great grandparents benefited from. So I'm sort of getting into hydroponics myself, but it looks like we are seeing the agricultural ETFs uptick. We are seeing some food shortages somewhere, some related to the virus situation, and I think you're going to see higher prices in the agricultural sphere. So we are long some of those exchange-traded funds and agricultural stocks, and there have been upticks in many of the commodity markets. So I think you're going to see more of that coming here this year and maybe the year after. So I would, stock up on some food. I would start growing some of your own stuff, and if I'm wrong, you just got some extra food.
Are you bullish on marijuana stocks?
Yes, I've been since 2014 when I launched the VR Trader Cannabis letter. I was one of the first ones in that market in terms of a big letter. I think I was the second or third letter ever created in that sector. I actually tried to launch an ETF for marijuana, and everybody else did it. I was in there. I actually had an application into a mutual fund group back in 2014-15, and their board turned me down because they thought it was too risky, or that the regulatory authorities would, come after them. Meanwhile, as you know, several exchange-traded funds and other funds have been created around that sector. I was right in there day one, and I don't think it's over. Of course, there's a little shift now in the sector. There's this area called psychedelics now, which is the other type of substances like LSD and things like that are now seeming to raise their head in terms of interest in the scientific and commercial communities for their benefits for health and other reasons. So rather than just trying to get high, or we just started having delusions about things as we did in the old hippie days. But the psychedelic stocks seem to be a spin-off of the cannabis sector, and there's a couple names out there. We've got them in our newsletter that are generating some interest. But it's a new industry. It started essentially. It's been around forever, as we know, thousands of years. But it just started new, and it had its stumbling blocks. Canadian, in particular, because of overproduction and a small market in Canada, and some of the U.S. names have done really well down here, and we have those in our newsletter, some that have expanded all over the U.S. and actually making money. And it's a growing industry, and it takes time for it to grow. And you may not see the Canadian stocks back to their all-time highs that you saw in the last couple, 3 years, but you are seeing, new highs in some of the names in the U.S. that are branching around the U.S., and maybe some of the Canadian names like Canopy Growth will get into the U.S. market and ultimately, go back to its highs at some point. So I'm long-winded answer. It's a growing industry. There's going to be survivors, and there's going to be people that go out of business. But I think it's a product that people want or are developing an interest to, particularly the CBD market. And I'm a big proponent of medical marijuana. I've seen a lot of help to people that have had physical and other problems, mental issues that were helped with medical marijuana. And of course, you've got companies like GW Pharmaceutical out there that created products like Epidiolex and Sativex for neurological disorders. So, there's benefit to it, and it's a growing industry, and I would say stay positive, but you got to pick the right stock.
The winter solstice, December 21st, was a big day in the astrological, geophysical world. Were the markets affected by December 21st?
Absolutely. People sort of laugh when I talk about this kind of stuff, and they're really being narrow-minded. They think the whole world is the physical world they just see around them, the street lights and the shopping centers and television and radio, but there are planets, there are stars, and there's a universe out there, and we're a very small speck in the scheme of things. And we did have that conjunction between Jupiter and Saturn on the 21st. And what happened to the stock market, Jim, on that day? We had a 500-point sell-off that morning on the 21st. So in my opinion, that had absolutely had an effect. We were talking about watch out for the 21st. It turned out it was a one-day sell-off, but it did shake up a lot of people. It was also the day of the winter solstice. And these dates have importance. And I've been writing about them in my newsletter for decades. You have to keep, there's other things out there besides watching national financial television and learning about earnings reports and what people say they think is going to happen or not happen. But there are forces out there that do affect the planet. And, whether they're long-lasting or short-term, that's really the big question. I've seen some have near-term impacts of some significance. So though, I'm a market technician, I'm an analyst, I've been around the street, for 4 or more decades. I've seen a lot. I've spoken to a lot of analysts. I've seen a lot of things, and you got to keep an open mind because there are a lot of tools and indicators out there that are just not mainstream that could have some bearing and some impact. And the big low we saw in March this past year, coincident with the COVID event. Well, that was just around the vernal equinox, and I had predicted 2 months before that time that we would see a low in March even before the virus became a international story. And that was partially based on the vernal equinox, because there tends to be a change of direction on many occasions, as I mentioned earlier in this broadcast, in March. Sometimes it could be highs, sometimes it could be lows. So, you don't know the intensity of that. You just sort of know that that's a time frame you got to keep an eye on. So to answer your question, December 21st was important, and I'm sure we're going to see a lot of other dates come up that we want to pay close attention to.
Are there sectors that are benefiting from an end to the lockdowns in some states?
Well, that's a good question. I'm not really focusing on which sectors are benefiting right now. I mean, basically, the restaurants have suffered in many locations, so that certainly hasn't really benefited. And so I'm going to have to pass on that one. I really don't know who is benefiting, other than the overall the overall market doing well here. So I don't know which sectors are really going to benefit from the slowdown. We know that if the virus is not cured and this vaccine doesn't work, then obviously, there's going to be a big push again for more research and more biotech type of, interest in those companies. But I would say, though, as the virus disappears, assuming it does, all these stocks that have run up, not the Moderna, not the Pfizer names, not that group, but, the ones that have been sort of tagging along, so to speak, I think they'll lose momentum and there'll be more of a sell-off. So I'm a little bearish on the biotech drug group, because a lot of them have run up because of the virus, and as this vaccine gets dispensed, I suppose a lot of that wind is going to come out of those stocks. So that's the only answer I can give you at the moment. I'll have to do some more research on the benefits.
Any other sectors you're bullish on now we're going into the new year?
Mostly individual stock trades. And, the group that, of course, has been hot anyway, the stocks that are related to the EV sector, like the electric vehicle group, they had big run-ups. There's still a lot of interest. I mentioned Tesla a moment ago, running over 700, so I'm keeping eyes on some of those names that are producing those, I guess you call them EV makers. They still seem to be, a hot commodity. You got to trade them. They've run up quite a bit. And, alternate energy stocks are still on our monitor list. I don't want to mention all the names, but, there's a few out there that have been running. So like anything else, you don't want to chase them. You want to hope to get a little, pullback. But there's definitely still a push for alternate energy, electric vehicles. I still haven't given up on solar power. I've been recommending that for a couple years or more, and it's done really well, but I don't know if that's over either. There's still going to be a push for solar and alternate energy. So I guess that, that would be sort of the hot group that, everybody's still looking for, and all the stocks and companies that support that industry would also have to be, closely monitored as well.
Are Robinhood traders good for the markets?
Oh, I can't say yes or no, Jim. It's not I wouldn't say a negative. I guess the more participants you have in the market, the better. You want to bring new buyers in. You want to bring in young people. You want to, you don't want this to, you're not going to grow unless you attract new money. So, what the Robinhood and those type of companies have done is, they allow people to come in with lower amounts of money, even in some cases fractional shares of some of the big companies. So I would say it's, sort of pondering your question here a little bit, I would say it's more of a positive.
Do you find that large caps, mid caps, or junior stocks seem to be the most profitable?
I would say all the above. I mean, I can point out examples that have all done well. They all run in their cycles. Sometimes the smaller caps come in a different market cycle than the bigger names, but I wouldn't exclude any of them. I think it's a balance, and it's also deciding which companies that you're focusing in on. I mean, you could be in a senior gold stock, a high cap gold stock, and you could be in a junior stock, and they would be considered, small cap versus big cap. It's the same industry, and they're both doing well. So I don't differentiate it. I look at the sectors, I look at what's happening in the market, I look at the individual stock itself, And, I don't pigeonhole them. No, the Russell 2000 has done well recently and has been a standout. So a lot of small companies have been doing a bit better, and some have noted that they've been outperforming. And maybe, this is the time, since the big names have run so much, maybe we will see a little more excitement in the small caps than we've had up to this point in time. But if you look at the charts on the sell-off this past year and the recovery, the Russell, along with the big cap stocks and the NASDAQ, pretty much have all been running together. I mean, they all sold off into a selling climax in March, and they've all been recovering pretty much in tandem. So, to me, it's all the above. They're okay. I don't separate them out, though I do look at individual names and see if they're worth investing. I mean, there's a lot of little stocks that have become big stocks here. So something that's small cap one day suddenly becomes a huge big cap stock. And I guess one of the biggest examples would be Tesla, which, went from $12 to $15 a share, $20 a share to $2,500. So anything could happen to any stock.
Mark, where can people access your special offer?
Okay, go to vrtrader.com. Victor Robert, vrtrader.com. Go to the order page for any of our newsletters, and in the promo code section, enter that promo code 2020 half off, and you get 50% off of any of our newsletters. And again, I want to wish all the listeners to House Street a happy and healthy new year, and let's look for a much more positive 2021.
Mark, thank you so much for being on the kickoff edition of 2021's This Week in Money.
Thank you for having me. Take care.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. Coming up, Bob Hoye next on This Week in Money.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob, and Happy New Year.
Yes, indeed. A Happy New Year to you and to our listeners. And may 2021 be an improvement in many ways over the conflicts that have appeared in this ending year.
And, of course, our hind vision truly will be 2020.
Good one.
And our regular listeners will know Bob loves to answer your questions because they're so good. And we have a two-part question from our good friend Michael. He says, "Hi, Jim. Happy holidays to you, Bob, and all the other wonderful guests on HouseStreet.com. I have two questions for Bob. With the latest seasonal stock market ramp, Wall Street is singing 'Tis the season to be jolly. However, for Main Street, it seems more fitting to sing 'Tis the season to be fearful, confused, and powerless. Wall Street is taking the Fed's express ski lift effortlessly up the wall of worry, whereas Main Street is tumbling down the slippery slope of hope. Fed Chair Powell says, no problem, because equities are priced fairly given the low level of interest rates. Powell also says that the U.S. Congress is the problem because they should be doing more spending to help Main Street. Bob, isn't the Fed the problem? And what will it take for the public to point the finger of blame at the Fed?"
Wow, good question, and I like your one about climbing a wall of worry, because decades ago, I can't remember which bull market was peaking, I crafted the line that, and it's a classic, and this one has been around for a long time, but then I added to it. What it is that every bull market climbs a wall of worry. Now, what I did was amend that to every bull market climbs a wall of worry, and then in a rush of enthusiasm leaps over the wall only to find Murphy waiting. And of course that refers to Murphy's Law, which is when things go wrong, they go wrong. And that's what happens here. So the latest rally came out of October. There was a few setbacks, and our view was that the season for setbacks was ending, and the next natural high for the financial markets could be in the December-January window, and then pointed out that some of the great speculative moves historically have concluded in the December-January window. A unique one was the terrific speculation focused in Tokyo, and the Nikkei then peaked on the last trading day of 1989. And then separately from this, in the stock market, the U.S. stock market even found a turn-of-the-year peak for the stock market in December of 1893. So they happened. Oh, yeah, and then there was the fabulous gold and silver speculation that peaked on January 21st of 1980. So then we want to notice what the Fed Chair Powell said, because equities are priced fairly given the low level of interest rates. Well, the chairman is being a little naive, and to get what's really going on, you want to look at the real interest rates, particularly the long end in the senior currency and with the treasuries, long-dated treasuries. And the pattern there on every great financial bubble is that real long interest rates come down. And going all the way back over 5 bubbles back to the first in 1720, there were 3 of those where real rates adjusted for inflation got to minus, like -5 or -6 level. And then when the bubble's over, real rates go up. So the Fed Chair Powell is either speaking the public story or naive. I expect both.
The second part of Michael's question. Bob, as interest rates are approaching zero, how does the Fed pump asset prices higher from here? It seems that the Fed wants to push asset prices higher by creating inflation, but how do they do that while maintaining near zero interest rates?
Yeah, well, again, we've covered the zero interest rates. Real rates go to zero or go to minus, and that's fine. The concern is when they turn up. But here's the other one, is a confusion on cause and effect, whereby the Fed ardently believes that its special issue of credit forces an increase in the economy. And that is that's like saying that the rooster's crowing in the morning causes the sun to rise. It's a confusion about causation and correlation. And if you look at the history of the business and interest rate cycle for hundreds of years, interest rates, nominal interest rates, the ones you see day to day, they rise in a boom, and they go down in a decline. So the idea that the Fed can come in with a special amount of liquidity, and that will prevent a recession, that's been around since before the Fed was formed, because movers and shakers in the early 1900s knew that if you had a financial crisis, it would be followed by a recession. And this was the term then, and is still used, as the Fed becomes the lender of last resort. And while the story is still appealing, it's never worked. We're now in the 19th recession since the Fed opened its doors for business in January 1914, and the tout then was that it would prevent recessions. So it's crazy. It just doesn't work. So, but the excited financial community, particularly those who learned about inflation in the 1970s, which was real inflation, the CPI was going up faster than wages, and there were those distressful conditions. And the big action was in commodities and hard items. Remember the saying, don't buy anything that unless when you drop it, it hits your foot. So anyways, there's a decade when the public will choose to speculate in hard assets, and then there's a period of time when the public chooses to speculate in financial assets. So one of the headlines, and I'm anticipating it, is that the Fed ease now is a recipe for hot inflation in 2021. But the inflation has happened and is happening, and it's in financial assets. You've got the yield for German 10-year notes down to minus in the financial markets and in financial history. That's the equivalent of gold going to 30,000 or some extravagant number like that. So the inflation, price inflation, is already in the market in financial assets, and in which case history points out that you have a period of inflation in tangible assets, and then with the same expansion of M2, you had a sudden shift, and then you have inflation in financial assets. And once the inflation in financial assets burns out, it's been followed by deflation of everything across the board. And this is the sixth time around. So then, in 1929, the Fed was extraordinarily easy during the first part of the contraction. But I think we can continue this one after your message here.
We'll have more from Bob Hoye when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking to Bob Hoye. Bob, have we ever seen such a spectacular climb out of a crash? I'm speaking about in March 23rd, the markets plummeted, and since then they've been on fire. Have we ever seen such a spectacular climb out of a major correction?
Yeah, out of 2009, out of the first crash in 1929, you get these tremendous rebounds. And one that I saw that I liked was a study on margin debt. And of course, the higher the market goes, the more leverage is employed, and the higher the New York Stock Exchange margin debt becomes. But this researcher had noted the percent change over a certain number of months. I think a 50% increase over 7 months or something like that. And that has been part of an ending action, and it's happened a few times over the history of New York Stock Exchange margin debt. So yeah, this is a very good indicator here now, and so going back to the opening theme was that we were looking for a rally out of the briefly depressed conditions in October, most likely in December, January. And of late we're getting measuring terrific excesses on the technical analysis. So this is where you get to ask the questions. Is the stock market up when it should be? Yes. Are there signs of speculative action? Yes, the excesses are terrific. And then the next question is, how sound is the fundamental story behind how good the economy is and how good the stock market is? Well, the economy isn't so good, particularly on the employment side, where unprecedented unemployment was forced by authoritarian governments getting hysterical about another flu. So, but on the other side, you have a boom in the financial markets and a bid for industrial commodities such as base metals and lumber, because as part of this boom and the great intrusion by governments is that people are leaving the central core of cities and moving away from those nightmares, which means that houses are being renovated, which means more lumber, and new houses are being built, which means more lumber and more copper and, that sort of stuff. So it's strange. You have a depression in employment, and you have what looks like a 1929 boom on the other side. And it also looks like this financial boom is approaching exhaustion and could likely fail and roll over within the next few weeks. We've got some technical benchmarks out there to make the call, and our readers will be made aware of the opportunity as it comes along.
The recipe for inflation in 2021 is a tsunami of liquidity going into the financial markets. Is that what we've seen?
Yeah, oh yeah. But see, the writer of that headline was looking ahead, and it's also looking for the old-fashioned concept of inflation, which is a soaring CPI inflation, Consumer Price Index inflation. And that, as I said earlier, occurs in a decade or a period of time, and then it's followed by inflation in financial assets. So all of the inflation that the inflation bugs are hyperventilating about is already in the markets. And again, I'm going to repeat, when you've got German 10-year notes declining to minus in a nominal terms, that's the equivalent of something like $30,000 in gold. So the big action is already in the market, and the history shows that once the mania in financial asset burns out and the contraction starts, it overwhelms the Fed's the Fed trying to inject liquidity and reflate the action. And we know that right in the worst of the 1929 crash, that the chairman of the New York Fed, he exceeded his authority by a factor of 6 times in buying bonds out of the market to inject liquidity, cash liquidity into the market. And then also you've got that wonderful part of an essay, an editorial in Barron's in July 1932, and essentially the gist of it is that every anti-deflationary measure taken by the Federal Reserve is seen not to be working. And that editorial pointed out that the Fed had been buying bonds out of the market in order to inject cash liquidity. So I'm going to stay with history, Jim, and once the financial mania is over, everything deflates except gold. And in a financial mania such as we've been in for the last decade, the real price of gold declined, the real price being deflated by the CPI, and it declined from 2011 to 2018, formed a base there, and has had a terrific increase in the real price. And the importance to gold miners is that increase, the decrease in the gold's real price with the financial bubble, diminished their earnings because their costs were going up higher, faster than the price of gold. So then the way it works in a post-bubble deflation is that the real price of gold goes up because everything's falling relative to gold. And it really enhances the profit margins of gold miners. It's absolutely terrific. You get some of your biggest speculative markets for gold stocks in post-bubble deflation. The 1930s was fabulous. I'm where the orthodox financial vehicles, stocks and bonds, are increasingly vulnerable. The story is building for a multi-year bull market in the gold sector, and merely on the real price going up, and the idea that gold is going to go to, well, the latest big number I saw that was published is 15,000. That's fanciful. The analyst hasn't done enough research. So, but in the speculative burst that will be ahead of us for gold stocks, it will be almost the equivalent, or be sort of the equivalent of as if gold really was at 15,000. But it doesn't have to go there. All you have to do is have the real price continuing to go up and profit margins for the gold sector improving. And here's one that we had work very well for us, because as the gold sector was bottoming in 2018, we did this historical bit and pointed out that the gold stocks were now into a period of time when they would outperform the Standard & Poor's or the New York Stock Exchange, whichever. And indeed, to the speculative high in August, the GDXJ outperformed the S&P by almost a double. Now that is outperformance. It is fabulous. And on the next bull move for the gold stocks, I believe that outperformance will continue. So definitely the gold sector is the place to be, and our technical research and historical stuff has been very good at getting our subscribers in, and then when it gets overdone, to get them protected. So, yeah, Jim, I'm really looking forward to 2021.
What happens when these billions and billions of dollars of government stimulus ends? Do they have to wait until the economy gets back to so-called normal, or will there be a big disastrous gap at some point?
Oh, good one, yeah. I think that the contraction will be severe enough that ordinary folks will look at the trillions of dollars that crazy central bankers have been throwing into the markets and say, hey, enough, your theories don't work, end of story, and will force, as part of a major reform movement, that the Federal Reserve System go back onto a gold standard. Then that serves to discipline reckless central bankers. You don't need them. It's like the quip in the 1930s in a very good how to trade book. Just can't think of it at the moment. But the quip was about stock market analysts, corporate, company analysts, and in a bull market, who needs them, and in a bear market, who wants them. And the same thing goes for the central bankers. In a bull market, who needs them, and in a bear market, because they're useless, who wants them. So I think there's going to be a major change. We've got a political reform going on where ordinary folk have had too much of government intrusion and too much of government taxation and too much of government inflation. and they're going to move to shut it down, and it's happened before. And part of that will be the public insisting monetary reform, and the best monetary reform, of course, be gold convertibility. So, in which case, here's one for your typical gold bug who may be calling for $15,000 gold. How do you get that when you're on a gold standard? The price becomes fixed, and it need not be fixed at $15,000. It may be just set at whatever it is now, like maybe $1,900 or something like that. But that's hypothetical, Jim, and I think it'll happen, but it'll take a few years of extreme distress before it does happen.
Also, we'll end our segment of the show with an interesting story, and I'll give a little background here. In the lower mainland of Vancouver, we have two major cable bridges, state cable bridges, the Alex Fraser and the Port Mann, and every time we get a major snowfall like we did on the first day of winter, they form what we call ice bombs on the cables, and they fall down on top of cars, smashing their windshields. But you found a headline, when it gets cold in Florida, what starts falling on people?
Yeah, the Weather Service in Florida offered a warning, an alert about falling iguanas. And the story's about the iguana, which is a lizard that lives in that region. And at nighttime, they sleep safely in the trees, and they can fall asleep, but they have an automatic grip thing to keep them on the branches. But when it gets very cold, these are cold-blooded critters, so their system sort of shuts down, and they go into something like a dormant phase, in which case they lose their grip and they fall out of the trees. So this is where a weather forecaster guy in Florida did issue a tweet, an alert about falling iguanas. And part of the tweet was that Florida was heading for the lowest temperatures in 21 years. So anyways, for any of our listeners in Florida, be wary of falling iguanas.
Bob, I hope you and your family have a healthy, wealthy, and prosperous New Year.
Thanks very much, Jim, and the same to you and the same to our listeners.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@housestreet.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Bob Hoye, and thank you for listening. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard, wishing everyone a healthy, happy New Year. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Happy New Year, Larry.
Well, Happy New Year to you, Jim. It's a pleasure to be on the show.
Larry, how is American Manganese looking going into the new year?
Well, I'm very excited about the new year. And, we're getting some interesting calls. Since the volume picked up and the price picked up, it's brought a whole new capacity of traders or investors. And the last time I talked about the predator trading, which is still alive and well in our stock. I'll give you an example. When we were closed on Monday, the U.S. was open. We traded 1.6, a little over 1.6 million shares, and there was 1 million of that was shorts. And so that just gives you an idea. Yesterday we had, out of 1 million traded in the U.S., we had 484,000 short volume. And on December the 24th, we had 1.7 million shares traded, and 736,000 of that was short trades. So, what I'd like to just go after here is I also talked about a reward that IROC and the Toronto Stock Exchange are putting up to turn anybody in that's, egregious in their, let's put it, in their enthusiasm to short stocks, where they're resulting in close to half or over half of the daily volume. And that is should never be allowed. So they've offered a reward of $5 million. So I would say to some of our more entrepreneurial investors that maybe they should look into this. There's a lot of money dangling out there if you can figure out who the shorts are. I think the shorts originate out of Europe by a fund, and they've got a group over here and in the U.S. that are shorting along with them. And I have good reason to believe that I know who some of the culprits are, but I don't have proof. And without proof, I'm not going to say anything beyond what I said. And but that can be gotten. And it'd be a nice payday for somebody to pick up a few $100,000 or $1 million on a company that's getting shorted as badly as we do. So I'd take a look on that, sharpen my skills on the computer, and try to find out just exactly where all this short selling is originating, where the big volumes come from. Now, if it was a fund in Europe, for example, they'd have somebody here, probably in Toronto, that would be shorting the stock for them. And so they'd have an account with them. And probably that broker is involved in shorting on his own side, and he's gathered up a few other people. So I can go back and say I think I know where it all started, but I won't bother with that. That's all speculation. And but I've followed this pretty closely, and I've been reporting predator trading, so the proof is in the pudding. Although you can't get numbers in Canada because there is no short rule, so who bothers to report a short position? And not very many, I don't think. Maybe a brokerage firm here and there, but or a bank, but for a big client, but that's about it. So if they want to have another Merry Christmas, I'd say go after that. That's a nice exercise you can do in the evening or the weekends, and see if you can't nail down the shorters in our stock. So other than that, it's been a short week, a whole day and a half for us here. And so the thing is that even in that particular period of time, we've had some interesting calls. And but when I say interesting calls, it doesn't mean it's going to end in some positive result, but there's always a hope that it will. And so that's as much as I can say about that. And besides the fact that the manganese samples arrived just before Christmas, and Quebec will be working on them early in January. That's for the Defense Logistics Agency and the DLA, and that's a grant that's being paid for by them, and it's almost a 48-month grant. So, we've got a timeline on that, and that's ongoing. So, plus, as I mentioned earlier, we were building the room for running the reactor, and so that is on the for the morphology. So that's on the go, and Hey, I'm excited, you know. Even though the stock hit 73 cents or whatever it hit here just before Christmas, you know, it's still trading at 40, and it's strong. There's a fair amount of volume every day, and so I see a real good future for next year for the company and its shareholders. And you know, I did say that I thought we were coming into a bull market a couple of weeks ago in one of my podcasts. I still believe that, and I know that everybody else is calling for a crash immediately and all this sort of thing, but that's not what I'm seeing or feeling in the market. So I'll stick by my forecast of a bull market next year. Next year not being just a day away, so we can go from there, Jim. It's you know, and I wish everybody a happy New Year. And if I missed it, I hope they had a Merry Christmas and good visiting time with their families. And for the Canadians, had a great Boxing Day holiday. Spent all their money on all the Boxing Day sales. But I will let it end here, Jim.
Larry, for people new to American Manganese, where are you traded and where can they get more information?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can get more information at our website, www.americanmanganese.com. Or you can phone the office here at 778-574-4444 and talk to me, or email me at LREAUGH@AMYMN.com. And have a Merry New Year.
Larry, best to you and your family and staff.
Well, best to you, Jim. And I think everybody's pretty happy here.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on December 30th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.